If you have $50,000 saved, you face a major decision. You can use it as a down payment on a rental property, or you can buy index funds. To figure out the better choice, let's look at two hypothetical people. They are the exact same age, living in the same city, making $55,000 a year. They both have that 50 grand sitting in the bank. The first person takes their money and puts 20% down on a rental property. Because they are using a 7% mortgage, that 50 grand allows them to control a $250,000 house. The second person drops their 50 grand into a total stock market index fund. They take on zero debt. Instead, they set up an automatic contribution of $300 a month and leave it alone. Over the next 20 years, both will assume they made the right call, and both will be completely blind to the hidden currencies they are about to spend. Year one for the landlord feels brilliant. The tenant moves in, an $1,800 rent check clears on the first of the month, and friends at dinner parties are highly impressed that they own property. The index fund investor gets a confirmation email. Nobody asks about their brokerage account. The money sits on a screen, entirely invisible to everyone around them. On paper, the landlord calculates the mortgage payment against the rent and sees nearly $500 a month in pure profit. Meanwhile, the stock portfolio grows a little, drops a little, and creeps upward. Without the heavy weight of compound interest, the early years of a stock portfolio are slow and agonizingly boring. If you judge these investments by how they feel in year 3, real estate wins by a mile. But feelings are terrible indicators of actual financial math. This chart shows the reality of that rental income over a 3-year period. You start with nearly $17,000 in gross cash flow. Then you subtract $3,000 a year for property taxes and another $1,500 for insurance. Then a water heater fails, a leaking roof needs fixing. Furnaces last roughly 15 years, and when they die in August, you write a $7,000 check immediately. And if the property sits empty for just 1 month between tenants, you pay the full mortgage with zero income. That massive initial profit shrinks down to just a couple $1,000s over 3 entire years. You can hire a property manager, but that instantly deletes 8 to 10% of your rent. If you manage it yourself to save money, you are now working a part-time job for free, handling weekend showings and late-night plumbing calls. And none of this accounts for a tenant who simply stops paying. An eviction can cost 3 to 6 months of lost rent, plus legal fees, erasing an entire year's profit in one single event. The saving grace is the tax code. Landlords can claim depreciation, deducting the theoretical decline of the building's value from their taxable income, even while the property actually appreciates. When you add all this up, real estate is definitively not passive income. It is a highly leveraged operational business that requires constant capital and constant attention. The index fund investor spends exactly 0 hours fixing toilets or screening tenants, but their strategy has a severe cost of its own. It relies entirely on unbroken time in the market. Looking at historical data, the stock market dropped over 30%. But by year 10, the gains on your past gains start generating more wealth than your original contributions, growing faster and faster. Index funds require zero physical effort, but demand ironclad emotional discipline. If you cannot survive massive volatility without self-sabotaging, the math won't save you. Fast forward 20 years. After 2 decades of maintenance and repairs, the landlord's equity sits near $500,000. Fueled by 10% returns and steady contributions, the index fund investor's portfolio lands in the exact same range. The real difference shows up when you try to scale. If the stock investor decides to increase their contribution by just $200 a month, the compounding effect pushes their final portfolio close to $600,000. The landlord doesn't have that option. You cannot buy a fraction of a house. To multiply their returns, they have to purchase a second property. That requires saving up another massive down payment, taking on hundreds of thousands of dollars in new debt, and entirely doubling their physical workload. Mathematically, neither path guarantees a higher final yield. The divergence is entirely about how much friction you are willing to endure to scale your wealth. If you want maximum control, are comfortable carrying heavy debt, and want access to legal tax shelters, real estate is your path. But it only works if you treat it as an operational business, with active systems for maintenance and tenant screening, not a weekend side hustle. If you value liquidity, refuse to take on debt, and lack the free time for emergencies, index funds are the definitive choice. This path prioritizes your time and freedom over asset control, but you have to prove you can ignore market panic and leave the money alone. Ignore social media claims that one method always wins. Look at your own life, your actual free time, and calculate what you can handle. The danger isn't picking the wrong asset class. The danger is committing to an investment without understanding the toll it will take on your lifestyle over the next 20 years.